Governments around the world are getting really good at playing the pro-crypto card. In the US, in the EU, the message is the same. They claim they're here to support innovation, to protect consumers, to give the industry clarity. But when you look closer, it's clear that their terms for support come with strings attached. Strings that put control, compliance, and currency dominance at the top of the priority list. Decentralization? That's way down. I don't think that's even on their agenda. No. It's why more and more people in the crypto community are calling it out for what it is, a facade. On Twitter, you'll see posts comparing today's regulated crypto landscape to a KYC'd casino, or even a pseudo CBDC system in disguise. They're not wrong. What we're getting isn't a free and open market. It's an enclosed system where you can play only if you accept total surveillance and full government oversight. The hypocrisy is obvious when you compare the rhetoric to the actions. Governments talk about fostering innovation, but it's always the approved kind. They'll throw resources at supporting stablecoins and certain DeFi projects that fit neatly into existing regulatory boxes. But privacy coins, non-KYC protocols, those are treated like public enemy number one. They say they want clarity, but the strategy has been enforcement over guidance. They say they respect autonomy, but they design rules that cement control in centralized hands. And yet, this isn't just a story of control. It's also a story of resistance. The more obvious the farce becomes, the more determined parts of the community are to fight back. Developers are doubling down on privacy-preserving tools. Self-custody is being embraced as not just a security practice, but a form of protest. And for those who still believe in crypto's original ethos, this growing skepticism towards government support might be one of the most positive developments we've seen in years. Now, if we zoom out and look at the last couple of years, the pattern of government actions becomes even clearer. From 2023 to 2025, we've seen a steady escalation, starting with selective enforcement and ending with full-blown legislative frameworks that tighten control over every corner of the crypto space. In the US, 2023 was marked by stalled bills like the FIT Act and the Blockchain Regulatory Certainty Act, both touted as steps toward clarity, but left to gather dust in Congress. Meanwhile, the SEC went after Coinbase and Binance with aggressive lawsuits, setting the tone for regulation by enforcement. Operation Choke Point 2.0 quietly pressured banks to cut off crypto businesses, and the government flexed its control by holding on to seized Bitcoin from high-profile cases. Now, across the Atlantic, the EU pushed ahead with MiCA, a framework that promised harmonization but came with a massive price tag. White papers alone can cost between 35 and 75,000 euros, and ongoing compliance can run into the tens of millions. And in the fragmented rollout across member states and its clear smaller projects never stood a chance. By 2025, the gloves were off. In the US, the Genius Act locked stablecoins into a heavily regulated mold. The Clarity Act moved forward to formalize SEC and CFTC oversight, and a special task force began targeting illicit activity before reserves legislation was even finalized. On the more pro-market side, ETH was officially declared not a security, and new rules for tokenized stocks and DeFi protocols were floated. The EU doubled down with strict transaction caps for non-euro stablecoins, tough AML enforcement, and an aggressive push towards its own digital euro. Meanwhile, on the global stage, US and EU agendas diverged. China advanced its yuan-backed stablecoins, and the battle for currency domination intensified. For all the tightening, there's also opportunity. These moves are drawing traditional banks into custody services, prompting a wave of ETF filings and even sparking proposals to hold Bitcoin as a reserve asset. For everyday investors, it means the possibility of 24/7 markets with deeper liquidity, but it also raises the stakes for keeping decentralization alive in the process. KYC, also known as Know Your Customer, is always sold to the public as a way to prevent fraud, protect consumers, and keep criminals out of the financial system. But in reality, it creates massive centralized databases of personal information that are irresistible targets for hackers, state actors, and anyone looking to exploit identity data. Now, these honeypots don't just sit there. When breached, they spill names, addresses, IDs, and transaction histories into the wild, fueling everything from phishing attacks to black market identity sales. The numbers paint an ugly picture. In 2023 alone, the FBI reported more than $3.7 billion in fraud losses. Between 2021 and 2022, the FTC logged 46,000 victims, losing a combined $1 billion to scams, many of which exploited stolen personal data. Chainalysis estimated $20.6 billion in illicit crypto transactions in 2023, and KYC data leaks only make it easier for bad actors to target victims directly. History is full of warning signs. In 2019, Binance suffered a breach that saw 7,000 Bitcoin stolen and KYC records leaked. In 2020, Ledger's hack exposed the personal details of 270,000 customers, leading to physical threats and harassment. KuCoin lost $280 million in the same year, and Coinbase had a 2021 vulnerability that compromised its user data. But the most alarming trend is happening right now. In May 2025, a third-party vendor breach exposed 69,000 Coinbase users. Bybit lost $1.5 billion in a 2025 hack attributed to North Korea's Lazarus Group. BingX was hit for $52 million in late 2024. NoBitX lost $90 million in mid-2025. And in May 2024, DMM Bitcoin suffered a $305 million theft. The scale and frequency are increasing. And it's not just about money anymore. It's about surveillance and control. State-sponsored hacking groups are now targeting centralized exchanges for both profit and intelligence. Even when exchanges themselves have solid security, their third-party partners often become the weak link. And that's exactly where personal data tends to be stored. The silver lining is that every high-profile breach pushes more people towards privacy-preserving solutions. We're seeing greater interest in zero-knowledge proofs, decentralized identity systems, and privacy-focused protocols. These tools not only protect users from fraud, but also reclaim the right to financial privacy, a right KYC-heavy systems erode by default. Non-KYC platforms have become the natural refuge for anyone who values privacy and refuses to hand over their financial life story to a centralized database. They come in different forms: centralized exchanges with optional verification like MEXC, Changely, or CoinEx, decentralized exchanges such as Uniswap or Haveno, and peer-to-peer marketplaces like HODL HODL. Each has its strengths and trade-offs, but all share the core principle of minimizing or eliminating mandatory identity collection. For many, centralized exchanges with optional KYC offer the easiest on-ramp. Platforms like MEXC provide a familiar interface and trading experience without forcing every user through a verification process. Decentralized exchanges demand more technical know-how, managing your own wallet, navigating gas fees, and understanding on-chain swaps. Haveno, for example, is designed specifically for privacy-focused trading. Peer-to-peer options like HODL HODL offer a middle group for Bitcoin users, facilitating direct trades without custodial risk. But non-KYC does not mean risk-free. Scams, low liquidity, and platform limits can frustrate newcomers. Many of these platforms have caps on withdrawal amounts or trading volumes for unverified accounts. Accessing them from certain jurisdictions can also require a VPN, which in itself can draw regulatory attention. From a tax perspective, privacy doesn't mean invisibility. Most centralized platforms allow users to export transaction histories as CSV files for tax tools like Coinly or TokenTax. With DEXs, the process is more manual. Every trade and wallet movement is recorded on-chain, meaning blockchain analytics firms can still piece together activity if they choose to. True anonymity takes active effort. As KYC requirements tighten globally, the demand for these alternatives is only growing. Yet regulators are now setting their sights on the platforms themselves, aiming to extend AML and surveillance obligations into the non-KYC space. The battle lines for financial privacy are moving from big exchanges to the last bastions of peer-to-peer trading. Despite the pressure, these tools remain essential for anyone seeking to maintain self-custody and transact without surrendering control. In developing countries, non-KYC platforms are often the only way people can participate in the crypto economy at all, bypassing both banking gatekeepers and local capital controls. In that sense, they're not just a convenience, they're a lifeline for financial independence. Now, stablecoins are the crown jewel in the government's so-called pro-crypto approach, not because they represent decentralization, but because they can be engineered to preserve the dominance of the US dollar and the euro while embedding surveillance into the rails. With over $230 billion in circulation and 99% of supply pegged to the USD, they're a powerful instrument for both monetary policy and geopolitical leverage. The regulatory mechanisms are designed to keep that power firmly in institutional hands. Issuers must back coins one-to-one with ultra-safe assets like short-term US Treasuries, creating a steady demand for government debt, which they need because we know they've been doing debt monetization. Circle, for example, holds over $61.6 billion in such reserves. Monthly audits and transparency reports cost millions in legal and compliance fees, pricing out smaller players before they even start. Licensing and capital requirements, such as the EU's €350,000 minimum under MiCA, further raise the barrier to entry. Redemption obligations, which guarantee a one-to-one cash out, can strain issuers during volatility, forcing them to prioritize liquidity over innovation. And the compliance overhead of AML, KYC, and even environmental reporting gives regulators multiple choke points to enforce control. These rules shape issuer behavior. When your reserves sit in treasuries, you care about interest rates and government policy, and that means lobbying to keep them favorable. Compliant issuers like Circle become advocates for regulation itself because it cements their market position. Operations grow more conservative, risk appetite drops, and the product becomes less about empowering individuals and more about serving as a digital extension of the fiat system. Globally, it promotes the use of US-backed assets in countries that might otherwise turn to alternatives. The escalation is clear. In the US, the Genius Act projects between $1.4 and $3.7 trillion in stablecoin-driven treasury purchases by 2030, effectively intertwining the crypto sector with federal debt markets. In the EU, MiCA imposes strict transaction caps on non-euro stablecoins, steering usage toward the upcoming digital euro. The result is consolidation of power among a handful of issuers aligned with state interests. Yet, there's a potential upside here. If the model can be decentralized, stablecoins already lower remittance costs, open up DeFi access in underserved regions, and give people in high inflation economies a dollar-denominated escape hatch. Now, the challenge is ensuring these benefits don't come at the cost of privacy and sovereignty. If truly decentralized stablecoin projects can scale, they might deliver the same utility without becoming just another cog in the central banking machine. Now, despite the heavy hand of regulation and the push to funnel crypto into tightly controlled channels, there are real and growing victories in the fight for financial freedom. At the grassroots level, decentralized tools continue to evolve faster than governments can legislate. Love the free market. Non-KYC DEXs and peer-to-peer markets are keeping the door open for private, permissionless transactions, while the push for self-custody protections in certain jurisdictions is safeguarding the very essence of user control. Innovation is also moving at a pace that regulation can't fully anticipate. Tokenized real-world assets, DeFi super apps, and lightning-fast payment layers are emerging to reduce reliance on intermediaries entirely. For communities and emerging markets, this means bypassing outdated banking infrastructure altogether, sending value directly, instantly, and often for pennies in fees. Now, institutional momentum is paradoxically helping the cause too. As banks enter custody services, ETFs bring in capital, and even governments consider Bitcoin reserves, the rails for broader adoption are being laid. Retail investors gain easier access to the market, and crypto begins to normalize as part of everyday financial life, making it harder for policymakers to roll back freedoms without backlash. Most importantly, the community-driven ethos is alive and well. Privacy coins, decentralized stablecoins, and even AI agents capable of autonomous financial transactions are gaining traction, quietly building a parallel system that resists surveillance and control. These are not just tools, they're acts of resistance. The more they're used, the harder it becomes for centralized powers to rewrite the rules of finance entirely in their favor. The pro-crypto facade may fool some, but the real future is being built outside the spotlight. It's being coded into open source repositories, run on home nodes, and passed peer-to-peer, far from the reach of those who would turn crypto into nothing more than a digitized fiat casino. The fight for financial freedom isn't just surviving, it's gaining ground. If you care about keeping crypto true to its original mission, free from gatekeepers, surveillance, and control, then take action now. Learn your tools, hold your own keys, and support the projects building outside of the system's grip. Because the fight for financial freedom isn't won in headlines or in courtrooms. It's won by the people who refuse to give up their sovereignty. If you're ready to dig deeper into these strategies and stay ahead of the game, head over to learningcrypto.com and subscribe here for more in-depth analysis, tools, and resources to help you protect your wealth and your privacy in the years ahead. Thanks so much for watching. I'll see you in the next one.